Hi, I'm Dr. Antonio Graceffo, and welcome to China Economic Research, coming to you today from Ulaanbaatar, Mongolia. Today's episode, U.S. taxpayers subsidizing the Chinese government. The largest project ever undertaken by any government in the history of the world, arguably, is the China government Belt and Road Initiative, which is a series of roads, ports, banks, financial networks, information networks, surveillance networks, which runs around the entire globe. The 50 developing countries which have joined the Belt and Road Initiative now owe an average of 15% of their GDP to China. So the money that is loaned to these countries comes largely from two sources. It comes from the China Development Bank and the Export-Import Bank of China, both of which are state-owned. So the basic model for the BRI financing is that a Chinese state-owned bank loans money to a developing country at interest, and that country then hires Chinese companies to come in and do infrastructure construction. They build high-speed rails, highways, things like that. So China immediately gets the money back because it's a Chinese company that's going there and doing the construction. That Chinese company will then buy their raw materials from Chinese suppliers, often state-owned companies, and they will even fly workers in from China to these developing countries to work on these projects. So at the end of the day, the countries get very little out of these arrangements, get very little financial benefit out of the BRI arrangements. They wind up heavily in debt to China, and China immediately gets the money back. But then the country has to start making the interest payment. A lot of these countries are considered insolvent by the World Bank or the IMF, if not insolvent, let's say on the brink of debt crisis. So the international lenders won't lend them money. So, of course, they go to their friend China, who's willing to loan them money, and then this pushes them over the edge into debt crisis. The BRI is able to function because of the state-owned enterprises in China. Just remember, you have state-owned banks, state-owned construction companies, state-owned construction equipment companies. You have state-owned coal companies, state-owned energy companies, and all these state-owned companies working together, and then also with the private sector. And this is how the BRI is able to function. Today in China, the state-owned companies account for about 25% of the Chinese GDP. And this even includes companies that are publicly traded. So a lot of people in the West might mistakenly think that if something is publicly traded, that it is not owned by the state, but the state may still own even controlling interest in that company, or 25% or 30%, or some significant percentage of the ownership might still be the government of China. In 2019, of the 156 Chinese companies listed on the three major U.S. exchanges, 11 were directly state-owned. Many of the others were state-controlled, where the state had even majority shares. 50 of the companies that were listed on the U.S. exchanges were not included on the Public Company Accounting Oversight Board's 2018 review. And the reason why is because China said no. They just didn't want to be included on the review. Number one, we have international organizations, including the American exchanges, that are making special rules for China that they would never tolerate from any other country or any other company. Everybody else has to be on the list. They have to submit themselves to audit. And, in these cases, China says, no, we're just not going to do it. And the exchanges allow them to continue to trade. Another thing is about the number of Chinese companies. This does not include Hong Kong companies, and it doesn't include offshore companies, which are owned by China. So what could happen is that you could have a state-owned enterprise in China that then buys or establishes a Cayman Island company. And it doesn't have to be in the Cayman Islands. It could be anywhere. But there's a tremendous number of Chinese entities that own Cayman Island companies. And then these companies that are outside of China could then list on the New York Stock Exchange and be treated as privately owned companies as opposed to publicly owned companies. And of course, it makes it very opaque because they don't submit themselves to the proper audits, and then we really don't know exactly who owns or controls these companies. But even companies that are 100% private can be working for the Chinese government. In fact, all Chinese companies, state and private, are both under the Chinese national security law, which was established in 2017, which says that Chinese companies are required to assist the government in intelligence gathering. So, for example, there's a company called Huawei, which provides 5G networks. The U.S. government, various agencies in the U.S. government, and other governments around the world have said that Huawei is a spy agency. We shouldn't do business with them. Do not allow them to operate your 5G. Huawei claims to be employee-owned because they give shares to the employees when they join, but those shares are not transferable and they're not portable, which at the end of the day basically means they are profit sharing. They are a profit sharing mechanism. The actual ownership of Huawei, 1% is owned by the founder, 99% is owned by a trade union. All trade unions in China are government, which means that Huawei is state-owned. But it doesn't matter. Even if Huawei is privately owned, as they claim, it is still obligated under the national security law to assist the government in intelligence gathering. Now, China's largest firms, both state and private, play a pivotal role in the country's economic ambitions and are often called upon to serve the state. And the government terms this advancing economic initiatives abroad. And this includes One Belt, One Road. Examples of how the government calls upon companies to fulfill government objectives. Xi Jinping asked the country's 97 largest companies, which they call the national champions, under the State-Owned Asset Supervision and Administration Commission, to stabilize the economy by increasing their profits by 9%. So the leader of the country has called upon the 97 largest companies and said, can you help us stabilize the economy by increasing your profits by 9%? So whether through direct ownership, indirect ownership, or by decree, Beijing controls China's companies, and companies serve the state's ambitions. Now, how does this relate to American taxpayers funding the Chinese government? So this is where it goes. Chinese state-owned enterprises have invested heavily in the United States, buying up everything from hotels to commercial real estate. Chinese investors, both state and private, have also been gobbling up energy companies such as AES Corp, Chesapeake Energy, and oil and gas assets. In 2010, China Communications Construction Company bought 100% of Freddie Goldman United, and in 2012, ATEC Wind Power, which is a Jiangxi company, bought 100% of Cyrus Wind Energy. Starwood Hotels, New York's Waldorf Astoria, was also purchased by a Chinese company. Other Chinese acquisitions include Ingram Micro, General Electric Appliance Business, Terex Corp, Legendary Entertainment Group, and AMC Entertainment Holdings. These are all examples of Chinese companies, whether they were state-owned or private-owned, making major purchases in the United States. Many of these purchases would be illegal if they were done the other way around, that an American company, particularly an American company owned by the United States government, would never be allowed to make these same purchases in China. But of course, the United States allows this to happen. And because we have a lot of business freedom in the United States, we have financial freedom, and we treat foreign companies pretty much the same as we treat American companies, they're allowed to make these large acquisitions. Now, in 2016, the USChina Economic and Security Review Commission, in its annual report to Congress, explained that the Chinese Communist Party has used state-backed enterprises as the primary economic tool to advance and achieve its national security objectives. They further recommended that Congress expand the powers and authority of the Committee on Foreign Investment in the United States, CFIUS, to block the acquisition of U.S. companies by Chinese state-owned enterprises. So under current U.S. law, a Chinese state-owned enterprise is allowed to come to the United States and buy an American company. But we have government agencies that are stepping up and saying this is not safe, this is not good, and they're asking for their powers to be expanded to be able to block these acquisitions. Chinese SOEs are so heavily invested in the United States that a number of U.S. government and non-government entities are now financing Beijing's interests, including the Export-Import Bank of the United States, as well as U.S. pension funds, mutual funds, private investors, and even U.S. government subsidies, which are going to Chinese-owned firms with close ties to the government. During the Cold War, it would have been unthinkable for U.S. sources to fund Soviet interests, but today trade negotiations between the United States and China are undermined by the fact that without yielding even an inch on trade, China can benefit from U.S. capital markets and investments. Remember, the U.S. has the most developed capital markets in the world, and allowing China to have access to that means that Chinese companies can obtain financing in the United States, and they can use that money to further the ambitions of the Communist Party of China. So the Export-Import Bank of the United States supports U.S. exports by providing loans and guarantees to foreign purchasers, and this includes China. The primary beneficiary of these services is China, to the tune of $2 billion last year, 3/4 of which went to Chinese state-owned enterprises. 3 of the companies which received the most funding from the Export-Import Bank of the United States are China Southern Airlines, the Industrial Commercial Bank of China, and Air China, all of which are state-owned. In 2014, U.S. Ex-Im extended a $300 million loan to ICBC for the purchase of U.S.-made Boeing jets. They've even extended financing to China National Nuclear Corporation, which engages in both civilian and military nuclear activities, including power generation and weapons production. So a United States institution provided financing to a Chinese government institution which makes nuclear weapons. It's very frustrating. In one bizarre case in 2002, the U.S. arm of China's state-owned oil company, Sinopec, was exporting services to the United States-owned China National Offshore Oil Corporation, financed through a Chinese bank. Because the exporter was technically a U.S. firm, because remember, a firm that's based in the U.S., even if it's foreign owned, is treated under our law as a U.S. firm. So because it was a U.S. firm, it was able to obtain financing from Ex-Im, and Ex-Im guaranteed $200 million of the financing. In 2013, a Chinese company acquired Smithfield Foods. The 2013 acquisition of Smithfield Foods for $7.1 billion by China's Shuanghui Group represents the largest Chinese takeover of an American firm in history. The move came at the behest of the Chinese government, whose 2011 5-year plan called for China to increase its food security by having both private and state-owned firms acquiring foreign food firms abroad. Smithfield, now a Chinese company, owns roughly 25% of all pork production in the United States.